right, Simon, it's good to see you again.
Welcome back to Rex and Simon Occasionally Talk Fintech. How are you doing, my friend?
I'm good. Yeah, I'm sorry that travels seem to make this harder than it needs to be. But
It's
it's
fine.
been a busy season. We've got a bunch of IPOs. Seems like 2025 is going to be the year of IPOs, and I wanted to dive into one of them, the Circle IPO. It's up 5x since listing in June, trading about $60 billion market cap. So tell me, Simon, is this hype and mania? Is this a sober reaction to an amazing company? Something in between? What's your take?
It's kind of wild, isn't it? It feels like peak stablecoins. You've got to consider that Circle has been positioning for a long time the company that would never IPO. They tried to SPAC in, I think, 2021. They tried to IPO a couple of times. They've not had much luck, and here they are, and they've made it. And congratulations to everybody involved.
And
But
this business was a pivot from an earlier business in
this is the
2019.
third pivot. So
Third
pivot
pivot, yeah.
originally it was like a consumer wallet, like a Sling Money, like a Venmo type of thing. Then it was like more of a trading OTC desk. They were buying and selling and helping you as a brokerage.
Yeah.
Then it became the stablecoin company. And of course, it's one of the big two, right? Like in stablecoins, 99% of the liquidity is either in Tether or it's in Circle. And in the past 12 months, Circle has gone from being relatively sort of a smaller player compared to Tether to meaningfully growing from about 30 billion of stablecoins issued up to about 60 billion. But the way it's done that is through buying distribution. It's done a
Yeah.
partnership with Coinbase, it's done a partnership with Binance. And what it does is it gives 50% of its revenue to those distribution partners. So I could make a case that like this is an amazing company and all of this sort of stuff, but on a pure like earnings multiple basis, it's absolutely wild level of valuation. I think there's a good tweet from the guys over at Artemis saying that something like hundreds of times multiple on earnings is where they're at. This
Yeah.
looks like absolute mania. So you have to ask the question, what are people seeing in this company? Are they seeing narratives? What do you think they're seeing?
I think the narrative they want to buy into is that this is the next big platform and they're two winners. I think the biggest criticism is A, just the price that you're paying to get in, but B, the fact that they are paying for distribution.
Yeah.
Highly problematic. But if you look at other networks, Visa, MasterCard, Visa makes on average about 7 bips per transaction.
Yeah.
They're giving up, 90% of the economics or more to the other constituents in the ecosystem. And they've obviously done
They did all
fabulously
right.
well. Yeah. So paying for distribution, I mean, if you're a network and you become big enough, it can be okay. And paying for distribution can be the thing that cements you. But are they a network yet? Well, the latest stats I saw are they have 4 million in wallets holding greater than $10, which for a global platform, at a $60 billion valuation, Chime's got 8.4 million active users. Visa is, worth, I don't know how much right now, 600 billion, maybe more. They've got hundreds and hundreds of millions. So we're still early from a true network story, but there are two platforms right now. It's USDC and it's USDT, Tether.
And Tether is one of the most profitable companies on a per head count basis in the world. They have a tiny
Yeah.
head count, tiny wage bill, but they're sort of the offshore dollar. Tether and Tron are heavily used in the global south, but there's always been sort of this question about reputation with those guys. They would argue it's for financial inclusion. They go to places that other people don't want to go, and they try and include them. But there's also the real question about anti-money laundering, counter-terrorist financing, and so on. Whereas there's Circle, a fully fledged public company that has probably been the single most vocal and driving force for stablecoin regulation and legislation. And of course, now we're in a position with the Genius Act having passed through the Senate and headed down to the lower house. We could see this inflection point through the Genius Act where now banks and large treasury companies and every stablecoin, every fintech company suddenly wants to get into the stablecoin gold rush. And who would you choose if you're onshore and you're mainstream? Would you choose Tether, which is reputationally risky, or would you choose Circle? or would you try and issue your own? And we just don't know. But if I'm a public markets investor, there's not a lot of places I can go bet on this
Yeah.
platform shift, and Circle is one of those places.
And they're the only one that's audited, and they're the most neutral of
No,
the
so
platforms.
Paxos is also audited, but they're not publicly traded. There
Yep.
are a few others that are issuers that are fully audited. Tether says its audit is coming soon. We'll believe it when we see it. But you could also make the bear case that says not only does this company give away 50% of its revenue to distribution, but it's incredibly rate sensitive. And with all of the pressure on rates, with the European Central Bank cutting, with lots of global central banks starting to cut, with fears of that coming to the US, what happens if rates do come down? Circle makes nearly all of its revenue today from those rates.
Yep.
But then this is a company that's a survivor. Like it's pivoted 3 times. If the business model changes, but they already have the distribution, is this a land grab market, or is this the MySpace of stablecoins?
And to draw back to the comparison to Visa and MasterCard, Circle could be a huge, huge business doing much more volume than those companies. But those companies are on an interchange-esque basis, right? So it's pretty stable revenue that tends to attract a higher multiple. So to some extent, the quality of the revenue might be slightly a separate conversation from the importance of the platform, and therefore, but it does open up questions about the ultimate enterprise value of Circle. I'd like to take this conversation of just understanding the competitive markets, the competitive landscape here, because Visa and MasterCard are definitely leaning into like stablecoin world. PayPal, Walmart, Amazon, all making noise about issuing stablecoins. Coinbase is talking about new functionality to build on top of stablecoin rails that could be differentiated from how Chargeback operates. So let's just walk through what some of those other competitors are doing and how real those feel.
Yeah, the number one for me is actually JPMorgan announced JPMD, which is a deposit token. So you got to remember that a stablecoin is defined in the Genius Act as something that is one-to-one backed by cash or cash equivalents. So this could be treasuries, overnight repo, deposits held at a financial institution, but one-to-one. The difference between a deposit from JP Morgan, of course, is they don't have to one-to-one back that deposit. They can use that for fractional reserve. They can use that deposit as a funding mechanism to create new liabilities, aka lending. So it's a different credit risk, but then it's also able to do something that a stablecoin cannot do under the Genius Act. Circle would not be able to pay you yield. So if you hold a stablecoin, that USDC does not generate you any return, but a deposit token from JP Morgan could deliver you a return. So you sort of end up in this space where you're going to go adopt that stablecoin, or if you're a big enterprise, do you want this other thing from JP Morgan that's already plugged into everything else you do and gives you all of the benefits of a stablecoin, instant, 24/7, global? And that's what people are really buying into as the value proposition of a stablecoin. We have instant and 24/7 rails in many parts of the world, but we don't have global instant and 24/7. Unless you use JP Morgan Connexus, but even that's a closed loop. Stablecoins can just get to parts of the world really, really quickly. So the competitive battle here is starting to heat up on deposit token versus stablecoins. Never mind who's the stablecoin going to be. Now, you mentioned Walmart and Amazon, right? Like, my goodness, do they love those big merchants? Love an excuse to go kick the card networks over the fees.
Hate the card
They've
networks.
been trying
Hate
to
paying
do
fees
something
card
called
networks.
decoupled debit for a long time, which is this idea that I can take my debit card and I can link it to a bank account, and it doesn't have to run over the Visa and MasterCard rails. Now, that would be something really, really interesting if we saw something like that emerge, but it never has. So I don't know how serious to take the Walmart and Amazon stablecoins, but if I am those guys, even just using it for my own operations, imagine if instead of trying to move money around at a bank, I could just issue my own stablecoin, be collecting the yield on that stablecoin, and moving that between my clients, my marketplace, and whatever else. in different parts of the world, or all of my buyers and sellers and all that sort of stuff, if I'm moving stablecoins around instead of moving bank money around and FBO account money around, I could collect that yield. So it might
Yeah.
be a more lucrative way for me to move money between customers on my platform.
Yeah, I think the Amazon and Walmart stuff is completely overblown from like, is the world going to start using their stablecoins? But from a, could they launch kind of an in-house store of value thing, a la the Starbucks balance? Only it's not for consumers, it's for all of the vendors and other folks in their
Yeah.
ecosystem. It just has a better ledgering system and it's better connected to other places. I think the example of something like this having worked is Ant Financial as a spin out from Alibaba, and Yui Bao, which was the largest ever money market fund, grew
Yes.
faster than ever. And there no stablecoin involved. It was just you're a vendor on the Alibaba ecosystem, which is like Amazon for wholesalers. When you get a sale, now you have a balance that earns yield. No stablecoin required, blew up, huge. So maybe something like that could be real here, but like, are you and I, Simon, going to use this to pay for stuff? And are other people going to use it for international payments, B2B, B2C? I don't think that's the case. So I think it's definitely narrative hijacking, maybe internally use case, but it's really USDC and USDT seem to be the biggest ones.
Well, and let's not
Here.
forget our friend, the Bank Holding Company Act.
Yeah.
You've got to remember that the permitted payment stablecoin issuer (PPSI) are overseen by the federal agencies above 10 billion,
Yeah.
or state level below that. So this, you are looking at a class of financial institution, really, and I think that line, if you are a big tech company, starts getting pretty blurry pretty quickly.
Yeah. I think one other use case that both of us have been paying attention to that I'm tracking. So there's the USDC or stablecoins for international transfer. Super interesting. I think people are generally aligned there. But there's this other thing of like, could you build new mechanisms for like disputes and chargebacks that are better than what the networks are? So the bigger story is, is there fundamentally new functionality that can replace some of what we're doing in the consumer payments world? Maybe share just a little bit about your thoughts on some of those very early stories.
So Coinbase and Shopify announced that they're going to start accepting USDC through Shopify merchants quite quickly, but they did it with the Coinbase e-commerce protocol, which is built on their own network called Base. But they built a bunch of smart contracts, stablecoins with logic wrapped around them, because stablecoins are programmable, right?
Yep.
And they, instead of having the classic model where I authorize a transaction and I see that the point of sale goes beep, but my balance doesn't get updated for 2 days, which is how the card networks have always done it historically.
Yeah.
What they do is when you go to make a transaction, the money doesn't move immediately through an auth. What it does is get pushed into an escrow contract. And whilst it's sitting in that escrow contract, an operator, this could be a network operator, can decide whether or not those funds get released to the merchant in this case.
Yeah.
And that is called sort of authorization and capture.
Yep.
And that could also move back from the escrow account to the consumer if the goods are not delivered, if the consumer disputes it, or whatever else. You could imagine a bunch of use cases. So what always made Visa, MasterCard, all those companies special was their rulebook and the fact that they'd created this incentive mechanism for participants. What Coinbase did is say, well, this is how we're thinking about doing it, but they didn't necessarily set that many rules about how it should work. It's like this open source framework. But the space for people to build new networks on this new infrastructure is wide open.
Yeah. Yeah. If you think about, the networks are networks, they're rules, and then they're like the actual functionality. If you think about something like disputes, the network is amazing. The rules they've built up, everyone's bought into over time, but the functionality kind of sucks. You like do a dispute, and they're like, okay, you're approved. You like call the bank, it's a waste of time. You do a bunch of emails, it's a waste of time. And you like wait 2 weeks, and you like don't really know if it's showing up. Whereas here, you could see like real-time visibility, much better stuff. But what Coinbase and even Shopify don't really have is the full network. The rule book, I think they can copy, right? Because you can kind of like, here are the rules. Let's like generally take the rules, but you really need to build a network. But it's fascinating to think about, are there going to be some new affordances that would get some merchants to be like, oh, actually, I would love to get rid of half of my or 70 or 80% of the folks who are working in, chargeback and disputes. So
Completely possible. And then there's this third role called the operator, and that operator is the network operator in this case. Why wouldn't that be a Visa, MasterCard? Why wouldn't that be somebody else? And it's going to get spicy for sure when the Genius Act passes, because
yeah,
I certainly see all of the signals that we're at the peak of inflated expectations, we're at the top of the hype cycle, but we're also in a place where clients are implementing this stuff. I'm seeing
yeah,
this stuff go to production. I'm seeing total processed volume past the multiples of billions, not just for cross border, but in some domestic use cases in the global south. And regulatory clarity is unlocking that. Every fintech product manager, head of product is sliding into my DMs. What do you think about this that we're building with stablecoins? That is a big signal.
yeah, totally. I know you got to run, but I think that's what we'll spend a lot of time on stablecoins over the years is whether the hype continues or starts to decline. It's like, where's that real world utility starting to get built? Awesome.
Heck
Good to
yeah.
catch up, Simon.
Good to occasionally talk fintech with you, Rex.
All right. Cheers. Take care.
I'm going to run.